When it comes to office building commercial real estate, there are many types and participants, so structured thinking and analytical methods are essential. Daisy Huang summarizes the following analytical framework and participant dimensions. Each year, she combines her extensive experience in commercial real estate transactions with research reports from major industry giants such as CBRE, providing a snapshot of the Canadian and Toronto office markets, their current state, and key indicators. All capital seeks profit. And the capitalization rate is the most critical indicator of a commercial real estate asset's value and return. It reflects changes over time in an asset class's valuation, income performance, and risk trends. The higher the risk of an asset, the higher its capitalization rate. Government bonds are considered risk-free assets, so their yields, or capitalization rates, are the lowest compared with other assets. Looking closely at the trend of capitalization rates across different types of commercial real estate in Canada, we can see that in recent years, the usual risk ranking from lowest to highest is multi-family residential, industrial, retail, office, and hotel. Over the past 5 years, office properties have shown the largest increase in capitalization rates, indicating that the market perceives office assets as riskier, which in turn has driven down their valuations. Breaking it down further, the risk ranking of office buildings in Canada from highest to lowest is suburban Class B, downtown Class B, suburban Class A, and downtown Class A. This shows that the higher the building grade, the lower the risk. As Canada's largest city by GDP, Toronto generally has capitalization rates for all types of office buildings that are 0.5 to 1.5 percentage points lower than the national average, reflecting more stable and secure returns. Interestingly, unlike the national pattern, Toronto's office risk ranking from highest to lowest is suburban Class B, suburban Class A, downtown Class B, and downtown Class A. This indicates that in Toronto, location provides stronger risk resistance than building grade. Looking at investment volumes across different types of commercial real estate, CBRE data shows that in the first quarter of 2025, office investment in Canada shrank significantly compared with the quarterly average of the past 3 years. In the Greater Toronto Area, office investment transaction volume in the first quarter of 2025 ranked in the middle compared with other commercial real estate categories, lower than industrial, retail, and development land, but higher than multifamily residential and hotel investments. Lenders have their preferences and risk biases. CBRE's latest survey shows banks prefer increasing loans to single-family homes, retail stores, and industrial properties. They intend to maintain lending for high-rise apartments and hotels and reduce loans for office buildings and development land. This aligns with credit risk assessments showing increasing risk for development land and office assets, while retail and industrial are considered lower risk. The service sector is the main pillar of the national economy, and office vacancy rates are an important indicator of its health. Over the past 3 years, both Canada and Toronto have seen significant increases in office vacancy rates. In Toronto, the rise has been sharper than the national average, placing clear downward pressure on valuations. Interestingly, Toronto's downtown financial district maintains a much lower vacancy rate for Class A office space compared to lower grade or suburban offices, indicating that large companies and banks still actively seek premium office space amid the return to office trend. Conclusion: despite economic headwinds and unavoidable tariff adjustments with the U.S., uncertainty is decreasing. The U.S. Federal Reserve is likely to initiate rate cuts, which will ripple globally and lead to further rate cuts in Canada, providing a boost to industry, services, and commercial real estate and serve as hedge against the headwind. While many real estate participants remain cautious, doing nothing is not an option. Strategic planning and that activity within the industry continue as good deals and opportunities still emerge. Office market risks and valuations have changed significantly in recent years, requiring caution. For small and medium-sized businesses with office space needs, leasing may be the wiser choice,